Hi, I'm Vivek Kartha, and welcome to Deconstructed. Every episode, we're discussing the future of the world's largest asset class, real estate, through the eyes of the people who live and breathe it. Thank you for joining us, and let's get started. Today's episode is brought to you by Workspace. Workspace has built a better way to manage real estate without all the clicks. With a suite of modern, intuitive products for commercial real estate operators, Workspace reduces the friction between assets, data, and people, allowing CRE professionals to streamline all their daily operations across property management, asset management, and beyond. Learn more at www.goworkspace.com. Hi, everyone. I'm joined today by David Ferrero, who is the EVP of Capital Markets at the Laramar Group, and also works on their sister platform, 94 Ventures. David, thanks for joining us.
Pleasure to be here. Thanks for having me.
I want to start first with the real estate side of your mandate and the work you do. And if you think just back to the crazy 14, 15 months we've had, how do you think about extrapolating trends and observations from this weird period into the future?
I think as I look at this particular shock or the upending of the real estate market, I compare it to some of the prior shocks that I've lived and worked through in my real estate career. And there are some really material differences, and there are material reasons as to why those differences are in place. And to borrow an old phrase and perhaps convert it into a somewhat tortured analogy, if you think back to the global financial crisis in 2008 and 2009, a catchphrase you would hear over and over again amongst investors was the concept of catching a falling knife. And they were using it almost in this monolithic description that the entire investment market was falling in tandem. And if you can visualize it, you were trying to figure out when to invest. And if you reached out and you caught the knife at the wrong time and the market was still falling, you'd slice yourself ultimately, right? That's the behind that phrase. And the key question everybody had is, when does the knife stop falling? So that when you reach out to catch it, you're grabbing the handle, it's stopped, it's harmless, and you're in good shape, right? Meaning you've missed the bottom and you've passed the inflection point and things will only get better. I think what we've learned over the past 15 months is that this shock or dislocation is materially different, and that certainly for real estate, it is in no way monolithic. I think even from everybody's reading of a New York Times or a Wall Street Journal or any other news source, you're seeing the stories that gateway cities are suffering and smaller cities are growing. San Jose is losing people, San Francisco's losing people, and Boise is picking them up. CBDs are losing people, but suburbs are picking people up. Life science and warehouse and apartments are doing really well, both in terms of demand from residents and tenants and in terms of investors and willing buyers, while at the same time, hospitality and retail and office have suffered. So to take that analogy of catching the falling knife and trying to extrapolate it, the kind of tortured variation I've been thinking about the past 15 months is picture yourself standing at the bottom of a flight of stairs. And instead of one knife, somebody drops 10 knives or 15 or 20, and they all come falling down towards you. One or two will bounce past you harmlessly, right? That's Boise or life sciences, no harm. Another one will slice you a little bit. Yet another could hit you in the jugular or the heart, right? If you had a large portfolio, bought at the top of the market in hospitality or Midtown Manhattan, you could be seriously in harm's way. So that to me is the what is different this time. That has ramifications for the playbook. What do you do? What should you do? And that playbook varies based on where you are, suburban properties versus urban, what kind of property types you're in, life science versus hospitality, and even what regions you're invested in. Are you in Austin or are you in Chicago? Very different outcomes, which ultimately leads me to why is it different? In some cases, understanding why it's different starts giving signals about that playbook and what you want to think about and look for and what you want to be doing. The fundamental distinction here is this dislocation was not driven by a typical economic recession. It's not financial factors, right? It's not economic factors. It's public health factors that really drove this dislocation. As a result, the policy response at all levels of our government has been materially different. Even our own societal behavioral responses have been materially different in terms of how we handle the dynamics that are here. Thinking about some of those differences, what this has done is it's created almost a temporary form of stasis where it's very much a hunker down and get through, as opposed to what you typically see in a shock where the market structure allows for a complete dislocation in asset pricing, where all asset pricing is reset at a lower level so the market can clear and you can basically start over again. That hasn't happened here for a variety of reasons at federal, state, local levels. Right? We've had multiple rounds of fiscal stimulus. We've had all sorts of monetary initiatives from the Fed Reserve. We've had limits tenant evictions. We've had support for forbearance. We've had limits on foreclosure. All these things have come into play that have really allowed people to continue. If you're a tenant and you have a hard time, you can stay where you are. If you're an owner or a borrower, the lender may not push back on you, even if you're in technical default in your loan. And so in this circumstance, aside from some troubled debt in the hospitality sector and certain portions of the retail sector that were probably in trouble even before we went into the pandemic, you're not seeing a lot of what I would consider traditional distress in the real estate markets. I think back to the RTC days when I first really got into the space as a professional. That was real distress. Anybody who had money was buying properties that were already foreclosed or as REO properties or loans that were in the process of being foreclosed on with borrowers who were in or about to go into bankruptcy. Despite all the challenges many businesses have had, we have not seen that kind of a dynamic in this situation.
So do you think about that as just a deferral or perhaps extending that period of dislocation over a longer period of time that will all play out in time? Or is this just more of a temporary blip and we didn't see the shock to asset prices as an overall class? There have been, yes, some winners and losers, but the market will just continue up and to the right in general going forward.
I think as I look at the flows of capital and the money being committed to real estate and the dry powder that's already been committed to fund managers and the activity, the sales activity in certain markets, I think most participants are certainly expecting that it will continue up and to the right at this point in time. Frankly, in certain markets and certain property types, a lot of longtime participants are scratching their heads and comparing this to 1999 or a real estate equivalent of the dot-com era. The phrase of it's virtually irrational exuberance in terms of certain property types certainly either indicates that people are simply trying to put money to work at a spread over treasuries so that they can get some sort of yield on the money and the wealth and the capital they have, or they truly believe in a very strong recovery and maybe even inflationary environment is ahead.
Yes, if you just simplify it down, and I'm no sophisticated real estate investor, and just think about the basic fundamentals of investing: buy low, sell high, think about where the market is going, supply and demand. And I hear a lot of excess capital in the space is going to assets. Generally speaking, people have the same observations: data sciences, Sunbelt markets, moving suburban, all the things you've mentioned. Do we get dangerously close to that B word, bubble? How would you explain that to an average everyday person?
I think we are probably dangerously close to the bubble or a bubble of some form, or maybe at least in some markets or in some particular property types. By way of example, we are even though we have not invested much, we remain very active in apartment acquisition markets across the country. And if you look across a lot of those Sun Belt markets, the vast majority of properties that are going to market will see more than 50 active, sophisticated bidders participating at meaningful pricing levels for every single investment that a broker brings to market. Very frequently, we're seeing pricing that boggles the mind. Very frequently, we're seeing pricing that goes well above 10, 15, 20% above what the broker indicates is the seller's target pricing. So there are some analogs to what we've all been reading is happening in the single family market in certain hot places. We're also seeing really surprising terms that people are putting out in addition to high pricing so that they can outpoint the competition. It's in most normal cycles, it's very rare for a buyer to offer to put up a deposit that's non-refundable before they can even visit the property. That's happening as a regular tactic at this point in time. We're finding people putting up those deposits and not asking for an access agreement, which will allow them to start due diligence. We're finding people preempt sales processes by making a fully fledged purchase offer before the asset even really formally goes through its sales process. So we're seeing a lot of the signs you would typically look for in the lead up to a bubble as indicators that trouble is coming. Question remains, what are the objectives of those buyers? What are they seeing? Are they strategic buyers? Are they financial buyers? What are their return objectives? Not all that is clear yet because we're not necessarily aware who all those buyers are, but we're certainly seeing behavior and pricing that I think for market veterans is concerning right now.
Yeah, I think that there are parallels exist, like you said, to single family home, to individuals investing in equities. Everything's at a global high that's interesting. That scares us, or at least the fundamental assumption of don't buy at the peak. But at the same time, it keeps going up. And there's no alternative, catch 22.
And there's analogies in the public, the stock markets as well. I was talking with my mother-in-law a year ago, who sold some family land and wanted to put money in February and March of last year into the stock market. And I said, don't, just keep it in cash. Let's wait. At some point, there will be a disconnect and we'll be able to get good pricing for you. It just can't keep going up. 15 months later, all financial markets keep going up. Her money's still in cash, right?
I empathize with your mother-in-law. Well, I want to move over to the other side of your world that you've been involved in for a long time, the venture capital investing PropTech side. At least 15 years you've been directly involved in that space. PropTech has come a long way. I think they say we're on the third generation of PropTech, maybe fourth. What do you just think about that arc and where we were 15, 20, 25 years ago and where the industry is now, which is a sea of PropTech investors, a sea of Series A, B, C PropTech firms, I think thousands of them in the US alone. Just what's your overall story behind that trend?
I think that the real estate market has matured in a lot of important ways in the last 20 or 30 years. And until probably about 5 years ago, most of my work in the PropTech space was as a user and as an occasional guest lecturer. But if you look across the space in the RTC days, the early 90s, you may have had 5 private equity firms or investment banks show up to buy a really exciting portfolio of non-performing assets. Margins were wide, returns were wonderful. There were risks, but they were understood at that point. The market has matured so much. There are so many participants, and there are so many people with multi-cycle experience that the margins have been compressed. And if you have a good idea, it's not yours for long. And so a good opportunity is repeated by others or copied by others very quickly. And what that has meant is that as the level of interest rates has gone down and the sophistication and maturity of the business has gone up, the ability to generate really good returns has diminished. And the ability to generate really good returns consistently over and over again at scale has gotten harder and harder to do. What you found is you found owners and managers working really hard to find ways to add the proverbial nickel or dime to the return. And so you found increased emphasis on looking at the nuts and bolts of operations and the nuts and bolts of transactions and all the disparate elements of the real estate field to find ways to create efficiencies that can at least add a little bit more to the challenged margins. So as technology has emerged, I think it's natural, given that in some ways real estate is perhaps has been historically one of the least impacted by technology of any major industry out there. There's a joke in the construction field that until recently, the most significant technological improvement in construction in the last 100 years was the invention of the nail gun, which is still a mechanical implement, as important as it was. And so the expectation, the reality meet that there's a lot of opportunity. There are a lot of different ways that you can create efficiencies, generate margins, improve value, reduce expenses, grow revenues. And that is the timing of that and the emergence of software, lots of SaaS product, has really come at a great time for the real estate industry and all the players to find ways to really expand margins and generate greater returns. So it's, in some ways, from an outsider perspective, it can feel like, goodness, this has just emerged out of nowhere. But I think the seeds for the growth are really planted over the long term and how the real estate business has grown and evolved.
So technology gets adopted when it works, and it works in this setting, as you've captured for us, is it can help owners and operators expand margins, returns, revenues, so on and so forth. When you look at potential companies to invest in, what excites you? What do you look for? Because for an earlier stage venture, I imagine it must be hard, especially in this space with cycles and timing, to prove out a very quantitative ROI in the early days. So when you look out at the field, what sort of proof points are you looking for, and what gets you really excited when you see a venture?
Really good question. I think that from my own time in the past few years being inside an emerging tech platform, what became really apparent to me as a user, and then again as a company trying to, member of a leadership team trying to grow a construction tech platform, is that a lot of real estate participants and real estate decision makers are skeptical about PropTech. They've seen the stories and the taglines of move fast and break things. They've all purchased a software which overpromised and underdelivered. And they've seen it enough times that, as they would say in Texas, they feel like in some cases, emerging PropTech platforms may be all hat and no cattle. The challenge that comes from that emerges from that is there's a lot of downside for participants in real estate when things don't work the way they're supposed to. If you take real estate, really a fundamental piece of Maslow's hierarchy, right? Shelter, it's fundamental, it's a need. Shelter in the broadest sense of where you live, you work, and you play. The stakes are really high for lots of participants. Think about just a home builder. They have warranties. They're competing for business. They spent years building a reputation to sell homes in their market, to retain buyers as they move up. They spent years building relationships with their contractors and their subcontractors so they can utilize them whenever they need them. The stakes are really high for them to adopt a PropTech concept that's in beta test and not have it work. It creates liability for them. It damages reputations. If I'm a home builder and I adopt a construction technology platform and I use them to do work, and in doing that work, I take it away from the sub who's been really good to me for 20 or 30 years, that sub's going to go work for somebody else. And if that technology doesn't work, as a home builder, I'm in a really difficult position. My business is materially damaged. So it's not just the same as a social software technology where, okay, it's not the biggest deal in the world if I don't get the update from my friend. It's the difference between a want and a luxury versus, in some cases, a need that has real tangible consequences for the business owners and a lot of real estate participants. One of the really important things, I think, in understanding the growth profile of an emerging tech platform is, can they really deliver? Even recognizing that everybody should have a roadmap for how they're going to grow and expand, can your product deliver something meaningful without creating additional risks for its early adopters? And if the answer is yes, you're going to get wonderful feedback and you're going to get all the referrals you could possibly want, and scale should follow. I think a lot of people in the real estate space are looking for that. In many cases, participants in the real estate realm are hesitant to be early adopters because they're just not sure that the product will do what it's supposed to do, and they don't feel the marginal efficiency benefits warrant the much bigger enterprise value risk that they might be taking. What interests me in terms of the spirit of the question you asked is, I think at the moment, asset-light models are really interesting, meaning platforms that don't need to deploy a lot of capital into long-term real estate development to deliver results. What I want to see is a company whose product can have lots of iterations, lots of reps, lots of ability to quickly improve and get better and deliver more and more. Whereas if you're relying on a development cycle or a whole real estate process, just getting one rep can take several years. And so it's harder to get rapid feedback and improvement in a product in that kind of environment. So asset-light models are compelling. I think businesses that solve a tangible problem in a straightforward, easily understandable way are very compelling at this point in time. And I think data is one of these really interesting areas for anybody in real estate. And I think that there's perhaps some low-hanging fruit now, and there's some opportunity for some game-changing ideas in the future just in the data space. Right now, most real estate participants have data in several different domains, different software platforms. Some is old school paper, some is spreadsheet, some is in a subscription SaaS product. The property management data isn't aligned with the reporting data. The budgeting data isn't well connected to the underwriting data. The market data isn't connected to anything. So I think there's an incredible opportunity right now just to help real estate participants, managers become more powerful and thoughtful, just to help them organize their data and link and understand it and interact with it better. That to me is a really interesting, practical, important step. I think a game-changing step for the data space is once that information is brought together in a coherent fashion, is then to turn towards some form of AI or similar process to help people determine how to mine and utilize the data to be smarter investors, to have a better idea of when to sell, to have a better understanding of trends and their competition. That's the component where I really think that the PropTech space can make some really quick, easy, incredibly beneficial improvements, and where it could trend to really changing the game for everybody.
Yeah, that's really interesting. I think on the data side, particularly when you talk about asset light reps and minimizing risk creation, if you start with the stitching and bringing it all together, maybe the problem is there. The value might be deferred. It takes a while to get there, but it's understood. And the risks are pretty minimal. You're not, interacting with tenants, affecting returns, operational risks, talent. It's behind the scenes until it's not. I think that's pretty interesting. I would like to close and ask you one question that's a little bit more on the advisory side. For the owner operators in tech, for the owner operators out there that are looking at this massive field and thinking about, I know I need to invest in some tech, but there's a lot out, there's too much. I don't know that I have the internal bandwidth to run a proof of concept or a pilot. How do they get started? That's
a really great question. I'm a little spoiled in terms of my own experience with that right now, in that the Laramar Group has a sister company, 94 Ventures, and we've identified really a technology and innovation liaison to interact between the two platforms. She has the benefit of the vetting that we do on the venture capital side to understand within an ecosystem for a particular problem that needs to be solved, who's got the best product. And it helps us from an operating perspective identify who we want to bring in-house amongst a competitive set to help solve a problem and beta test and roll something out. The information flows in the other direction. We get it in our properties. We learn how it's working. And she is gathering the data and understanding what the real efficiencies are, what the real benefits are. Is it improving the residents' experience? Is it making our maintenance people's day easier? Are we getting through more work tickets more quickly? And can communicate that to the venture capital team within 9-4 to really understand, is there an overpromise and underdeliver, or is the product really delivering? And how is it working? And what's the likelihood that it would be adopted by other people when they understand what the product is really doing? So from my own perspective, I've been very spoiled and not having to worry about the spirit and the issues that your question raises. I think that for the vast majority of participants who don't have the luxury of the same position that I happen to be in, I would have to recommend that you pick your battles. What is the problem that's most important for you to solve? Or what are the problems that are most important for you to solve? Start with that and survey the market for 2 or 3 or 4 participants who have or claim to have a solution to your problem, and spend some time with them. Do multiple demos, ask for references, identify their existing clients, and understand what the experience has been of the existing clients. And I think if you're able to iterate through that kind of a process once or twice, you can minimize your risk of a false positive, right? That kind of a bad outcome where you spend money to deploy something that doesn't deliver. I think over the next few years, it's going to become more obvious who some of the winners are. Right now, one approach that would be easy would be to look at who's being bought out by a SPAC. That would tend to indicate that a platform has been able to grow and gain many clients utilizing its product. That doesn't necessarily tell you exactly how good the product is. However, you need to peel back the onion a few more layers to really understand the details that are there.
Yeah, something that raises in my mind is from the startup side or the tech provider side, if that's the way firms are going to get comfortable or potential clients are going to get comfortable with the new tech by relying on their peers in a pretty relational industry, it makes the value of delivering on what you promise, customer success and service along the way, that much more important, because your current customers are going to be the ticket to your future customers.
I agree. I think that you will find along that thread that a lot of decision makers in real estate are accustomed to that kind of relationship and customer service. And just being able to provide that, I think, is going to go a long way for any PropTech firm's capability to convince a skeptical real estate investment manager to adopt their product.
Dave, thank you so much for joining us today. I'm going to do my best to avoid catching knives by the blade over the next couple of years.
Either that or avoid stairwells altogether.
Take care, Dave.
Thank you, Vivek.
That's it for today. Thank you for listening. And, as always, a very special thank you to our guests. We'll be back soon, so please subscribe to Deconstructed on Spotify or wherever you listen to your podcasts. More details can be found at www.goworkspace.com/podcast. Today's episode is brought to you by Workspace. Workspace has built a better way to manage real estate without all the clicks. With a suite of modern, intuitive products for commercial real estate operators, Workspace reduces the friction between assets, data, and people, allowing CRE professionals to streamline all their daily operations across property management, asset management, and beyond. Learn more at www.goworkspace.com.